Bonjour, bonjour à tous.
Good afternoon, everyone. So we're going to start right away with this new conference on a highly topical subject, which is that of equity, very topical with the upturn of the economy. So equity for corporations and companies. So how can we direct the French people's savings towards companies? How can these companies get equity? So I would like to thank our four speakers. Patrice Moreau, you are chairman of PwC France and Maghreb. Stéphane Boujna, you're CEO and chairman of the board of Euronext. Eric Lombard, CEO of the Groupe Caisse des Dépôts. And Thomas Buberl, CEO of AXA. And before we start, I'm going to give the floor right away to Agnès Benassi-Kéré, who is chief economist in the French Treasury, and she will give us the framework of the topic. Yes, maybe I'm going to start with statistics with a macroeconomic note about 2020, as the Banque de France has noted, without giving you too many figures. The gross debt of non-financial companies increased in 2020 more than in 2019. I believe everybody realized that. But the net debt increased less than in 2019, which is not that obvious. And if I look at the first months of 2021 now, the net debt has decreased. This is a macroeconomic situation. Obviously, it varies considerably. Several institutions give us a microeconomic level to date. The Banque de France has looked at 200,000 balance sheets and believes 6 to 7% of companies might be in trouble. I don't know how they went to that figure. BPI Rexecode says that 20% of small, medium-sized companies are afraid not to be able to pay back the loan guaranteed by the state. And there are also a paradox for 2020. On the other side, you have the savings of the household. There's several ways of defining these savings. I will look at the gross additional savings for 2020 versus 2019. So it's an additional 100 billion euros because every year households save money. This is an additional 100,000. So this money will be spent partly for consumption, so it will come back to companies in this way. But the topic of the panel is how can we direct, I don't like the word direct, but how can we open the doors and inform them so that they realize there's an interest for them to invest part of these savings into equity capital for companies. So obviously, you can also increase equity via the margins and the results of the companies. At the end of the crisis, the margins will be larger than before the crisis. There will be an increase in the margins of these companies thanks to the reduction in production taxes. Now, if we look at equity, two things. With the PAC law, there's a renovation or renewal of equity instruments, and they are better adapted to the situation. The priority at the end of the crisis is not so much to find instruments than to make them known, stabilize the system, and support distribution via the networks that are not necessarily used to these instruments. And the last thing I wanted to say is that the important thing is not so much to have more equity, but to have a balanced result with a reduced ratio of equity over debt. So there will be an agreement on debt, especially for very small and medium-sized companies. I'm not going to look at the equity of pizza shops, but in some cases, we'll have to restructure the balance sheets and a major agreement has been signed so that there is this restructuring under 3 months so that this amicable agreement can be passed. So I'll stop at that. What's at stake is to help viable companies to pick up and be upturned, and to improve the balance sheets of companies that may not be in trouble, but that may have a reduced capacity to invest at the end of the crisis. Thank you very much, Agnès. Patrice Moreau. Agnès has given us snapshot of the topic. You have data from the field, so what can you tell us? I believe that the question everybody has is there going to be an explosion in the failures of companies, a lot of bankruptcies, the wall of bankruptcies? Let me remind you of a few figures. Every year in France, there is between 55,000 and 60,000 such procedures leading possibly to a liquidation of the company. It represents about 400 large-sized companies. In 2020, this figure was reduced by 40% and by 50% during the first quarter of 2021. Why? Because the companies benefited from the massive support plans of the public authorities. Today, they have been somewhat had a sort of infusion, and when do we take out the infusion, and will the patient be cured when we stop the infusion? So as far as the schedule for reducing public support, what we feel is that they're going to be reduced progressively in order to manage properly the number of companies that have to be restructured and find a solution for their upturn. And now we're seeing the appearance of new devices like participative loans that will take over from the PGE or the reduction in charges in order to manage these restructuring over time. As far as the company's financial situation is concerned, as was said, overall they didn't increase massively their indebtedness during the crisis. Agnès Benassi said that there was a survey from the Banque de France which has shown that the gross debt increased by 424 billion, by 224 billion euros, while their cash situation increased by 240 billion euros. So it seems that there are about 6 or 7% of listed companies that could be in trouble when these support measures are lifted. So don't expect a wave of failures, but there will be a correction that will be introduced for companies that were maintained artificially during the crisis, and this is rather normal. For those companies that are weaker or fragile, there will be two major challenges. First of all, to manage the over-indebtedness, the extra debt, and secondly, to fund the upturn, growth in the working capital, growth of investments when they have no cash. So what we've observed in the various regions where we are present is that companies need these equity, and all the more so since the failures take place usually at the time of the upturn or economic upturn. So these failures, when a company is liquidated, it's sometimes the only appropriate solution when the business model of the company is no longer appropriate, or when their sales base is eroded. But our economy needs a pool of dynamic investors and needs equity in order to give appropriate solutions to these companies that may have had an accident along the way, but that are rather solid as far as their basis is concerned. So good news, we're not aiming at a real wall of bankruptcies. Stéphane Boujna, when we prepared for this panel, you said equity is back, and when we look at the incredible fundraising, we may think that it's true. Well, says Stéphane Boujna, it's true that our planets are aligned in an incredible way. There are equities that are unprecedented. The needs for equity are unprecedented, with faraway risks and cash flows that can't be funded with debt. The demand is huge because equity investments give a better yield than fixed rates because, as you know, many people say it the whole day. In the best case, you get 0% yield, and after inflation and management rate, you get a negative yield. And the growth perspectives, as was said, are in support of a good valorization. So when you look at things in details, you feel you have all the elements for equity and action. And this may take several forms. Today, to say things simply, you have either the world of private equity or the stock exchange or hybrid tools like the SPACs. So we could look at it later on, but either you're part of the happy few that have access to private equity and you have no expectations for high cash, or you want to take the risk of shares and you have a demand for equity, and then you'll find it on the stock exchange or the share market. And there are three major indices. The number of happy few is unprecedented since 2015. We just finished the first half of 2021. We had over 110 IPOs on the Euronext market, and it's more than for the whole of 2020. And as some of us have said, the queue or the pipeline is extremely dense for the end of the year, even though for some of the elements, investors are more selective. Second marker is that private people are back. Remember that one of the seasonal or recurrent issue was why are private investors leaving the stock exchange? This world has changed. The number of private investors used to represent 2 to 2.5% of the Euronext books. At the beginning of 2021, it rose to 6%. It's now slightly down, but still higher than 5%. So the situation is such that the number of private investors has doubled in 18 months in France, with a whole generation of specific investors who, because of the lockdown, amongst the things that you can do in front of your screen, have been buying shares. So we have a return of private funds, especially for IPOs. And this is a tangible reality. And the third thing is that the values are still high, the valuation. There is some skepticism with the CAC above 6,500, while some of the loans haven't been paid back. But you have only one company in the CAC 40 that is managing restaurants, and you have tens of thousands of restaurants that are doing badly, and two companies managing hotels. So the CAC 40 does not represent the GDP. It represents large companies that can escape some of the restrictions due to COVID-19, especially with their global aspect. The panorama of shares is changing in a post-Brexit environment. We have an opportunity for the European continent to no longer be only a territory that is consuming products and finance that have been designed elsewhere. There is, there's JP Morgan, there's Google for the search engine, there's Amazon for e-commerce, but we have major insurance groups in Europe, in France, Italy or others, Germany, You have asset managers in France. You have very large European banks that are based in Spain, Scandinavia, or France, or also Italy. And we have the right market infrastructures for that, which is why we're very proud that in Euronext we negotiate about 25% of the share volumes that are negotiated in Europe, and we have an aggregate stock market valuation which is about 1,600 billion euros, which is a multiple of the Frankfurt Stock Exchange and about one-third more than in the London Stock Exchange. So this is a specific moment for equity. Eric Lombard. We've just been told that we're not aiming at a whole lot of bankruptcies. You can find a lot of money on the market or in the pipeline, lots of projects. Is everything okay, or are there imbalances? Well, we have one piece of good news and two difficult problems, including a serious one. The good news is that companies are doing well. There's a lot of savings thanks to the BCE, to the European Central Bank. You have the plan of the Caisse des Dépôts for recovery. But there's two difficulties. First of all, one simple one, the resistance of companies in our country to open up their equity. Very often they say, okay, we are accumulating result and we'll rebuild our equity. But there is an emergency and we have to be able to convince people in the corporations to open up their equity with investors that could support their company's projects and therefore be a growth driver. The other problem, which is more serious, is that of ecological transition. There was a panel earlier on talking about the necessary massive transformation of our economy. The energy transformation means huge investments because we have to change completely the way we generate energy. To go for renewable energy, have some nuclear, some hydrogen, some wind energy. We have to change transportation means. Public transport is shifting to hydrogen in many cities. Cars must shift from diesel or fuel cars to electrical cars, social housing, tertiary buildings, administrative buildings, plants have to change the way they operate. And we have to change the way in which we produce to aim at zero carbon. So we must massively invest, and the money is not there for the moment. And there's another need which is related to ecological transition and which is is the fact that it's quite costly. Someone who goes to buy organic vegetable that are produced locally, this is more expensive. So we have two imperatives. We must produce more and transform more, give more purchasing power to the wage earners. And with the present economic balance, this cannot be, because investors have only an 8% yield, which is not sufficient for that. There's not enough investment to balance the sharing between capital and labor. Sorry to talk about that. So there's not enough investment for ecological transition to be done as quickly as it needs to be done. You may have seen the last IPCC report. We had to do things yesterday. So the cost of equity is generating more projects, but it is defined by investors, and they want what their clients want. They are asking for 8%, which is rather funny because we learned in the schools that there was about 4% margin between long rates and short rates. But when they stand at zero, when this figure is 4, why are they asking for 8? When bond investments stand at zero, you can't ask for 8% yield on investments. So if we have to have the force with us, as Master Yoda would say, those who have understood that they have to change their model and be responsible at societal level and environmental level, they accept to change the expected yield, and this is very important. And some economists are starting to define this viewpoint.
Thomas Bebel, I know you agree with everything that's just been said, but you are not simply an insurance company, you also are a funder. You fund the economy and the transition. We've talked about this transition a lot. So what happens? How does that tie in with reconstituting equity? Well, we are now moving from one phase when the state was rescuing many businesses to keep them alive into a phase which requires investment. The insurance sector, an insurance company is traditionally very active in investment, and through regulations, the insurance companies are even more active than many banks in investment. Let me give you some very concrete examples on this. With AXA during the crisis, and now we continue to do them. During the crisis, we launched a 500 million fund to fund investments in businesses. And this was very tangible. It's a new machine, a new office, recruit people. That's what it covered. And I have many people who take that. And many entrepreneurs who are ready to open up their capital. As Agnès has already pointed out, we also participated in 2 billion and out of the 14 billion in participative loans to create funding in the long term after this crisis. And just 2 weeks ago, we launched yet another fund, 500 million. It's called Pipit and Territoire, to focus on local investment. So the insurance company is there to finance, to fund, not only to reassure, and that is done by collecting life insurance. France is a very strong country in terms of life insurance, and if I take a look at our client portfolio, we have all French men and women in it. It is their contribution to fund their businesses and also their local fabric. And for me, this is so very important. This saving must be meaningful to the French. They are funding and financing their businesses and we have products that are dedicated to this, which generate attractive yields, so that the life insurance remains a very appealing product. Obviously, we've got plenty of experience and expertise to finance. However, this is a point we can come back on later. The prudential rules have to help us to support these measures, and even more so in the future. We have encountered several barriers in terms of financial mass, which means that private investors will have to play a bigger role. They'll play a bigger role in what? Well, in my opinion, there are 3 main subjects where financing is needed. The first is the climate transition, and as that's just been said, this is the major challenge that we all have to face. It will require substantial investments. And here, an insurance company can help, wants to help, in the investment part. Second subject that we have on the table, and this is also key and it's absolutely clear for everybody after this crisis, and that is the question of health. We see that health costs have risen much more quickly than the GDP. We have to find simpler solutions, much more comfortable solutions, to enable us better to control costs. And a final subject, which we often forget about, and this is sovereignty. We have experienced a period during which other parts of the world have done much more to fund the sovereignty of the state, of the region in question. I think that there is a huge need for France and for Europe to give greater support to businesses which must be competitive on the world stage and which must maintain their positions as market leaders. And they are opposite other states which are helping either with direct financing or through enterprises in the different countries. Agnes was talking earlier on about that mattress of excessive saving and earmark. How do we earmark these savings to convince investors, the investor on the street, the typical household, to purchase these products that are going to go on to fund these SMEs and very small enterprises as well. So let's put the ideas on the table. Well, I think it's really important, and here I really want to stress on that term earmarked. We really do need to earmark these funds for the small and medium-sized enterprises, because this is the very foundation of the economic fabric in our regions. They're very important, and they are one of the components of the response that we're all looking for. We all agree that things need to move forward. I would give you the example of Sweden. I think it's, with its economic fabric, it's quite similar to ours, and it shows that there are 4 conditions needed to be more successful in earmarking your money and helping the small businesses. They've got funds in Sweden that can invest in very small structures. And here we can draw a parallel with the different debates that we have had when we're talking about our capitalisation funds and the retirement funds, etc. They're all very important because they can earmark and they can go and invest. The second idea is that they have a culture of investing. And here we're talking about educating the public. 6% of investors, private investors, and that's the figures enhanced, but it is only 6% of households that are investing. The French are averse to risky shares, whereas all studies show that holding on to shares in the long term is a win-win situation, particularly given today's low rates. So we have a subject here. We have to educate the French. We have to give them a financial culture so that we have more individual investors. This third condition is to have a strong ecosystem that focuses on these small businesses. There are more of them, and they're all spread all over the place. And the final one is tax incentives. But tax incentives, not necessarily those that focus on the wealthiest, but we need to have products that are accessible to the largest number of people. We have this in France, the livret A, with all kinds of rules and regulations. But why not have a livret B, a second version of this, which is for investment in SMEs and other tools? I think it really is important that we invest more and we earmark more of their investments for these small businesses, which really are the foundation of our different regions. Well, I'm not particularly worried here because for 2 years we've been seeing a shift from 2.5% or 3% to 6% in terms of individual investors, and that shows that there's a kind of collective intuition that if we want to be sure of having some kind of revenue when you're no longer in a position to work, then you have to add on to what the collective system is going to give you. And so I think everybody's sensing that now. In the United States, if you don't have any shares, if you're not saving in your shares, then you're in difficulty. And so the households are aware that if they haven't got some of their savings in shares, then the pension will be really small. So there are a couple of hurdles, of course, we have to get past for getting individual investors back in the market. That's the tax system. It's very punitive, up to the reform which gave that universal lump sum payment for private investors, which made it more coherent with what our neighbouring countries do. Let's keep fingers crossed that the future world will not question that, and that we'll just take it as given. The second thing is European regulations. The Solvency II, which is extremely punitive in terms of insurance ratios and investing in companies which are floated on the stock exchange. They're There's a big form, 50 pages. People are asked everything apart from the color of the underwear they're actually wearing. They have to give all the other information about themselves if they want to buy a share. And it doesn't sound very logical to me. And it creates an aversion to taking the risk of investing in shares. It's typically bureaucratic, as one would expect from Brussels, and it really is making people turn away from shares. The third point, and this is an industrial point here, for 20, 30 years, we have been not selling in banks, we're not selling shares in banks, but it's just so easy to sell life insurance, whereas the management teams can turn up in the morning, have a look at the rates, and go out and have a quick drink afterwards. This is a world which no longer exists. Investing in shares involves a lot of work. It's more complicated. It takes more time than just buying rates. And so there's a lot of expertise, industrial expertise in managing share risks has been lost. And so things are changing, obviously, but as far as individual investors are concerned, the light at the end of the tunnel is that we have online brokers now who are doing wonderful work, and everything's becoming digitalised. There are all kinds of apps available. All the younger generations can use them easily, and it's very user-friendly. Something I didn't point out earlier on was that the most striking thing in anthropological terms is that the individual investors are young. They're aged between 25 and 40, if you call that young. But it's totally different from the profile of a typical investor. So why are investors coming back? Well, one of the reasons is that we are getting them to get interested in things other than the blue chip companies. One of the anthropological factors is the reason that these youngsters have started to buy shares on the European markets. It's not only because they were stuck in front of a screen all day during lockdown, or because they're used to playing with Game Boys when they were little and now it's just the next step along. It's another kind of video game. It's because very often they started to buy shares of the products which they use from a very early time. A lot of their portfolios has got Google, Apple in it, Microsoft in it, all things which they use in their everyday. And so quite naturally they went to other blue chips. And so in the future, we're not going to get them involved in the territorial investments, which for some are thrilling, but it's not going to interest the younger generations. They have an appetite for shares because they get yield, because the tools are readily available, and there are online brokers which really have played a wonderful role in this. And all that ties together to ensure that we are heading towards a different world. And without wishing to be a bit pedantic, I want to say we are getting back to what we were like before the First World War, when there was no welfare state, and you'd either buy a government bond at the post office or you'd buy shares at the local bank. Eric Lombard, how do we seduce parents of these children? How do we get the parents to buy more structured products? Well, let's be realistic. We did a very interesting project, really. We had different diversified products available, different brackets of investment. We're going to do that kind of thing again. So it's a lot of work. European regulations are really difficult if you want to sell your shares through a network. However, we have to take stock of the fact that our compatriots like to buy life insurance, as has already been said. They like to invest in their livret A, huge amounts collected last year, which would be wonderful for investment. And so the we can only invest in shares insofar as the regulations allow it, because we know that it's the best kind of investments we can make for our clients and for the economy. We've been saying this for years and years, but nobody's listening. We have to just keep on saying it. The European regulations are going to have to be lined up with the interests of the insured parties and those who hold shares, the interests of the economy. When I entered into the insurance industry a lot of years ago, we had portfolios with 20% people would have shares in their portfolios, but now I think it's down to about 10%. So we're talking about a cash flow of about 13% in shares. But regulations are getting in our way. We really have to identify what the value is and the interests are, and we're talking about very high values. So there's a very fast, strong impact. Thomas Boubel, you are calling to see Solvency II. You mentioned it earlier on. Well, it is being reviewed, which is wonderful. We have been in a certain system for 10 years. We need to update it. But the question is how to update it. Do we update it thoroughly by examining each parameter and really changing everything? Or do we say, no, we're just going to focus on what does not work? And I think this second approach is the most practical one and the most pragmatic one. But that's not been adopted by Europe to date. We've just heard that Solvent II has to be reviewed to match up with the political objectives that we have, i.e. how can we fund the energy transition? Because there are no extra flows of finance. We just have to redirect the existing flows. And that will only happen if we change the parameters so that more money can be used to fund small and very small enterprises and the green transition. And I hope that will be the case. France is one of the states that dominates in this area. France is rather powerful and strong on this front. But I think there's another question, and this is why do we have 100 billion or 140 billion at the end of June? That is because confidence must be restored. People are waiting. They're frightened about what might happen. They don't know yet whether the crisis is really behind us. And so the risks have gone up, but risk aversion has also increased. And that means that we are going to have to help our clients, help those who are insured, so that they really can participate in funding the economy. That means, on the one hand, we have to find the right products, which really are what the individual investors are looking for. And we have to sort out the tax regime with that as well. It would be far better to encourage taxation to edge towards participation in the real economy and ensure that we really do find opportunities. Because nowadays it's not that easy to find opportunities. We've got a regulatory framework, which means that the banks are withdrawing from this activity. It's amazing to see we have only one banker here on the stage. The bankers have been the main source of funding for small and very small enterprises so far, but that's no longer the case. Which is why insurance companies and asset managers have to fill that gap. Thomas Boubel, you were talking about taxation. Is the tax lever something which could be used, and if so, how, to earmark funds for private individuals' investments into businesses? Who'd like to come back on that one? Well, I can try. Well, if we see new businesses. We have about 50% of our products which are accounts where the client takes the account of investing in the real economy, and 50% of the products carry a guarantee. And this is when rates are very low, so it's not the best really offer you've ever heard of. It wouldn't be so hard to say that we could shift taxation towards a minimum envelope so that the client could take the risk and participate in businesses. It could be possible. It's feasible, I think. Tax lever?
If we look at simple taxation and macro taxation on income and capital gain and the lump sum introduced by Emmanuel Macron's team in fall 2017 had more impact than fine-tuning product per product. So we have to think in terms of aggregate basic taxation. But I also think that regulatory elements can move more flows than tax ones. Solvency II reviewed would have more impact than the the tax elements that we're piling up in France. As I have known, the innovation taxation, we piled up years on years tax measure that was supposed to show the good intentions, the interest that we had for young companies, but we ended up almost nationalizing the technological sector through these incentives. So sometimes you have to take a step back and ask yourself what the taxation impact can be on the equity returns. Well, I agree. This, says Eric Lombard, this has to give us some competitiveness as compared to competitor. And if the interest of French people in the long term is to invest more in shares, and we're all convinced about this around this table, this should be enough without adding any tax incentives on top of that. So some common sense would help us and change us. One last point, we talked about cultural change, changing the culture of private investors. Mr. Moreau, I believe you're the one who mentioned the change in the ability of small and very small companies and medium-sized companies to open up to private equity. Well, Eric Lombard was saying, and I perfectly agree with him, that you have several elements. You have a reticence of French people and French companies to open up their equity. And at the same time, the young generations, I would say, have a desire and an understanding that if you work on your own and you have no more equity, you're going to stagnate. This is something we are observing more and more in our discussions with heads of corporations and with the young generation. We've talked about that, about the unicorns, for example. There is a real basic change on these topics. And we have to put more equity for these small and medium-sized companies and very small companies. Eric Lombard, because of what I do, I often go to the difficult areas in the cities. Yesterday, we went to the northern areas of Marseille. Contrary to what you think, there is an incubator there for young companies created by people who come from these areas. And we saw a very young team that had an agri-food project that was already in the industrial phase, and they were raising funds. So these young generations, as Stéphane said, have a more modern vision of how to develop a company, and this is very positive and should be developed. If I may add a comment, says Stéphane Boujna, all this works in an ecosystem of investment in equity. Okay, you have the yields, the intuitions on pensions, etc. But in the end, it's more complex and requires more work to invest in shares than to invest in rates. And it needs you need more people for that, more research, more analysts. And one of the reasons why it's difficult to get the management to shift towards equity is that some expertise has disappeared. Some economic models on research are creating de-incentive to investment. There are elements of analysis and research without which the investors are somewhat blind. I'm not trying to pile up the problems and say it's everybody's problem and so it's no one's problems, but there are a few elements which are almost managerial elements, basic elements. If we could find the 5 or 6 people who can look into a specific segment of the share market and look into them, how can we pay them over the long term before the trading flows appear. And this is an ecosystem issue that we have to solve, and we're faced with that problem. I'm quite optimistic because in the end, when the flows are important, everybody finds an interest in it. But don't underestimate this. For example, in the banking agency, you no longer have securitizer. In the past, you had specialized people who would say, buy some Saint-Gobain, buy some Suez, buy France Telecom. This job no longer exists. Some networks of banking agencies think, well, as we're trying to attract people to the agencies again, because they do everything online, maybe that would be a way. But there are some skills and competencies that have disappeared, and we have to find a new expression for them in a digital world. One question. No questions? Okay. Then this is putting an end to our discussion. A word of conclusion from Agnès. Very fast. Well, thank you very much. I learned a lot. First conclusion, no wall of bankruptcies, even though that is part of business life. This is the generation of the productive tissue. Productive fabric. Bankrupts are part of the rotation. A lot of people stop their restaurant or store voluntarily. It's not because the restaurant down the street closes up that it means it went bankrupt. So this is not worrying per se. The second conclusion is that we could have an equity time, equity moment, to pick up on what Stéphane said, for savers, change of model, which is ongoing, in fact, which was starting before the crisis but could increase, and a rejuvenation of the investors, which is interesting. On the side of companies, it's not as obvious. We talked about the reticence of people to open up their equity. We mentioned that there are distortions related to cash and to yield, and that it's extremely expensive. So, talking about solutions, we mentioned livret B. Well, we'd have to check that it doesn't exist per se with another name. We talked a lot about consumer protection, with Solvency II, research as well, the research model, the impoverished research for shares. And for once, taxation was not really mentioned, and I'm happy about that. If we had another hour, I would like to open up the discussion on equity for transition, because we'll have to tell people who are saving money that some shares might be more risky than others, especially at these times of transition, which is why it's so important to have financial reporting. We talked about economic culture. Is there a sustainable culture of sustainable economy and transition? Thank you very much. So that will be a topic for next year.